Hello, everyone. Welcome to Friday. Looking forward, as always, to our session, and we'll be getting started here right away. And I'm just sharing my screen right now. There we go. Excited for the session as always. It's always a good opportunity to review what's been happening in the market and look at some of the current positions that we've been following and talk about them in real time. Um, just really quickly, just for those of you who are here, and hopefully those of you who may be coming in later, um, you can interact with me in the group through the chat area. I pay attention to that throughout the course of the session. So if you have comments, for example, Gib just posted a good morning, so thank you, Gib. Appreciate that. Um, Please feel free to post there, and as you have questions or comments, I'll try to fold those into the conversation over the next hour. But with that in mind, let's go ahead and dive right in. Um, the purpose here for this live stream is not only to talk about current market conditions, but to put them in the context of the trades that I post for the Rebel Income System, and for our for those of you who are paid members and lifetime members of the Rebel Income community. And so we're going to be looking at a number of stocks that I've been following lately. Some of my most recent trades. We have a couple that are set to expire today. So we'll be looking at those and trying to talk about what some of the ramifications of the price movement relative to the trades that I've placed are, and talk about ways to try to think about how to respond and adjust if possible or necessary. So let's go ahead and get straight to it. We will start with CTRA. This is a stock that I was able to sell a put option on in mid-December, and that is set for expiry today. I sold the $25 strike price and brought in about 1.6% for the 30-day period. My normal target for these, and I talked about this at length in some previous sessions, is to average about 1.5% per month per position. The yield that I'm looking for is relative to the capital that I have to commit in order to secure that put sale. So I sold 3 contracts on this one at with a $25 strike price. That means that each contract controls, of course, 100 shares. So 300 shares times 25 is $7,500. That's the capital requirement that I have to keep in my account through either cash or margin in order to be able to cover the potential obligation associated with the put sale. So 25 becomes the reference price, and $7,500 is the number that I have to keep in mind for the duration of the trade, in order to make sure that I don't trigger any margin requirements or margin calls, etc. I try to make sure that I'm keeping these on a cash secured basis, meaning that I'm always wanting to uh, make sure that I have enough cash in the account to cover all of these potential obligations at any given time. So that's $7,500 for this one. Let's go ahead and take a look at where CTRA is here today. Yesterday was kind of an interesting day for this stock. I was looking at it a little bit before the market opened and at the end of business yesterday, and had this really big spike all the way up to 28.50 before it fell back. This was news that CTRA and Devon Energy are in talks to merge, and that temporarily gave a lot of people some reason to start pumping the stock pretty aggressively. But again, really, as far as my trade is concerned, $25 is really the reference price here. Now, clearly, with the stock pushing up closer to 26, barring a pretty serious collapse in price, looks like this one is set for expiry today. So I'm unlikely to be assigned. it's one of the things that I think is important to keep in mind for all whenever you're placing a put selling trade is not just the potential that you have for being assigned. A lot of people that use put selling use different approaches in terms of their attitude about the stock that they're working with. Mine is pretty simple. I never sell a put option against a stock that I'm not willing to own. So if I'm selling the $25 strike price, I am actually saying that that is a price I would like to buy the stock at. So I don't actually avoid assignments from my put sales. But in this case, it looks like it's going to expire worthless. The stock is showing some good momentum over the last 3 days, and so 4 days actually. um, and so looks like this is going to expire. That does open up the possibility for evaluating ways to possibly manage the trade a little bit ahead of time. And by the way, if any of you have trades on CTRA as well, of course, as always, please share your numbers and let's compare and see how you're doing relative to mine. And that's always fun. I like it when you guys do better than I do. All right. So again, the reference here is the premium that I brought in was 40 cents. Now, by letting the option expire, that means that I want to keep all of the premium that I brought in. It also means that I'm willing to wait for normal trade settlement to occur on my position. Normal trade settlement for most brokers these days right now is usually 1 to 2 business days. That means that once the market closes today, if the stock is above 25, the $7,500 I have in I have in capital reserve for this trade won't actually be released until Monday, possibly Tuesday. And that's okay. That's fine. I understand that. I work with that expectation. However, with the stock where it is right now, pushing closer to 26, and with this contract expiring today, time decay is practically nil. We're now literally counting it down by the day. And Barry beat me. Awesome, Barry. Thank you. He has the same position, but he brought in 50 cents, and that's good. That is a great result. I just you try to find the level that you think is good enough for you, and then you go from there. But if I didn't want to wait for that normal trade settlement to occur, if I wanted to accelerate that a little bit, there is an opportunity here at 25 to buy this back at the ask, which is 5 cents right now. Now, again, I could hang on to all of it and just let it expire. That's normally what I do. But the advantage in possibly buying this back is going back to that capital reserve requirement. The $7,500 that I have in reserve right now to secure this trade aren't going to be available for a few more days. I have to wait the entire weekend and then Monday or Tuesday before I'd have it available to trade again. If you have an idea of what you would want to do next with the stock, then there is an opportunity here to buy this back for a fraction of the premium that you brought in, 5 cents. That means that if I were to do this, I would hang on to 35 cents of the 40 that I brought in, obviously. And that in and of itself is still a pretty decent result. 35 divided by 25, 1.4%. I lower that drops a little bit below my normal 1.5% threshold. But now I can turn around and decide if I want to redeploy this capital, possibly with the same stock. If I want to keep working with CTRA, possibly roll up in time, roll up in prices, as well as out in time. That may be a possibility. 26.50 is the at the money strike price right now. The stock is just now let's see. Let me double check my pricing. 25.78. I take it back. 26 is the at the money strike price right now. So there's 20 cents available here. That's not awesome. Got a pretty wide spread between the bid and ask here for CTRA. This is pretty typical of some of these weekly options. Is the there's not a ton of activity that goes on in some of these weekly contracts, which is why I have usually, for most of the trades I've placed with this stock, I've had to go out at least a month. But yeah, so here's February week 2, which is out a month, and you can see very limited open interest. There's been no volume here at all, so not a lot of activity. That explains the discrepancy between the bid and ask on these. So that does imply if I still wanted to continue to work with CTRA, I could, and if I wanted to continue to bet on the bullish momentum here a little bit, I could. Where was this? 26.50 for next week, for example, considering the momentum of the stock, even though this is technically in the money put. I could try this one, but again, there's really nothing here in activity. So to be honest, right now, would probably be a matter of looking out for a couple more weeks. Putting CTRA aside, looking for, if I were going to try to roll my money here, it would really be probably a matter if I'm buying the current contract back and then looking for another trade with another stock. So I've used CTRA a number of times, but it's not always a continuous part of my trading rotation for this reason. Sometimes the overall trading activity in the options contracts is pretty light. So that limits not only how frequently you can move sometimes, but also how attractive they are. So yeah, thank you, Gib. You're exactly right. The bid ask is there's such a wide discrepancy in that when you see a big difference between bid and ask, 9 times out of 10, if not more, you can bet that it's because there's next to no open interest, to say nothing of volume. So, okay, so that is CTRA. Again, my normal method here still applies. The stock's still showing some, nice momentum here. Just refresh the price. Yep, still at 25.75. So I'm going to let this expire worthless and move on, and then I'll have the money ready for the next trade on Tuesday, and that's fine. That works out okay for me. Okay, enough on CTRA. Let's go ahead and move on here. The next one is another put sale that I placed on Christmas Eve on Target, obviously betting on holiday shopping. Selling the $92 strike price for a 3-week trade, bringing in about 1.68%. Now, because of the higher strike price on this, obviously, selling 3 contracts or 2 contracts would be a much larger requirement. So I sold 1 contract controlling 100 shares. So my capital reserve requirement on this is higher, $9,200, than what I was doing for even the 3 contracts on CTRA. I'm still within my 2 to 3% limit, but this is one where I'm starting. To be honest, I'm starting to stretch my position sizing just a little bit, but this is about as far as I'm willing to go. So let's take a look at where Target is right now. And this is a stock, we looked at this last week as well, and it's been showing a lot of positive momentum since late November, which is part of what prompted the the put sale in the first place. I mentioned last week when we were reviewing this that considering the pace and slope of the stock's acceleration since November, I would expect that the stock is going to retrace at some point. But the last 5 days, that's definitely not been true. It's just continued to stack positive days on positive days, and here we are now. So we're up above $111, and my strike price is all the way down here below the 200-day moving average. This looks like Target is in the middle of is in the very, very early stages of a very bullish trend reversal. It hasn't been confirmed yet, but we have a really nice upward slope, aggressive upward slope on the 20-day moving average, and even a little bit of bend on the 200-day moving average. It had flattened out, but now we're starting to get just a hint of a little bit of an upward nudge on the 200-day moving average. So those are bullish signs, even if I do still think the stock is ripe for a pullback, but we've probably got, just working off of the 20-day moving average, support is probably somewhere around 102. So I'm going to let this expire again, but in the vein of looking at how far the stock has moved away from that price, from 92, it certainly does beg the question of whether or not I could buy it back. Now, the caveat here with Target, I already mentioned, I'm kind of at the limit of what my position sizing rules are giving me right now. So to go, if I wanted to continue to work with Target, I would need to not only roll further out in time, but up in price. And that would be, here in the 110 range. Well, this is kind of interesting. If you have the room for it, here is the $110 strike price. Plenty of open interest here. There's a little bit of a discrepancy between the bid and ask, but even so, 113, it's a little over 1% for 7 days. Gives you a little over 4% for a month if you can repeat that 4 times, right? So that's actually a pretty interesting contract. Again, this is high at a higher price at this point than I'm willing to work with within my position sizing rules. But this is a good example of what you can do if you want to continue to work with the same stock, and you don't mind the idea of rolling that far up in price and a little bit further in time. This is only 1 week. So implied volatility here on these options is definitely a lot higher than what we were looking at on CTRA. That makes this kind of interesting, and I'm not recommending, obviously, a specific trade, right? This is for illustrative and educational purposes only. Sorry, I highlighted the wrong one, but it's interesting. You go out 14 days and even go one strike price lower to 109, and you're doing $1.63. So now you're getting up into the 1.5% range for 2 weeks. Again, these aren't terrible choices. It just depends on what you're willing to work with. So I do think that, again, I've already said that to place these trades would be stretching the limits of my position sizing rules. Here's what I mean. If I'm working with the $110 strike price, $110 times 110. This means that I would need enough cash. I need $11,000 in order to secure this trade. Now, the problem for me is not having that cash. I can cover that trade, but relative to the size of my account, that's about 3.6%. And I'm trying to actively stay between 2 to 3%. And in many of my trades, I'm even below 2%. Excuse me a second. Oh, I apologize. So this would be a larger position if I wanted to try to roll target. And so this is one where the movement is interesting. It's kind of fun to see, but it's moved past the limits of where I'm willing to work. That does not mean that target is no longer a good value. The value price that my analysis has set for it is quite a bit higher. It just means that for the size of my account, I've gone as far as I can go, and that's a matter. I think it's important to point out that's an active decision that I'm making on my own, and trying to think about how to try to manage my trades the most effective way I can think of. That means that sometimes you just got to be willing to recognize when it's time to move on to another one. And target may continue to rally here, and that's awesome. It it's going to continue to preclude me from being able to work with it if it does. So it would actually have to reconfirm the downward trend in order to give me another trade at a price I would be willing to work with. So we'll see. All right. From there, we've got really looking out into the next couple of weeks. So my next put sale here is on Occidental Petroleum. I placed this one on New Year's Eve, so just a couple of weeks ago. This is a 3-week trade set to expire next week. I sold the $41 strike. I think Barry is the one that I get to thank for putting Occidental on my radar. Oops, I can type. There we go. Okay, so stock's at around 43, and on my trade, I sold the $41 strike price. This was a nice 2.5% premium, bringing in $1.06 for 3 weeks of time. So this is a pretty nice trade. Obviously, again, this is in position if it continues to hold up for the next 7 days for the trade to expire worthless. With a week to expiration, though, and the stock's momentum where it is at with the stock, it's retraced the last couple of days, but it had rallied up to a little bit above 44, and now we're sitting right around the 200-day moving average, which I would expect should be providing some support here in the 43, 42 and change range. So it's so far been holding up there. We'll see if that continues to hold. $200-day moving average is usually a pretty good reference line for support. And at least in the very near term. We have back here in August a similar kind of pattern initially. Here's a push above the 200-day moving average, came down, hovered around it. Remember, support tends to be an area, not a specific price. So it did use the 200-day moving average as support here, rallied again, dropped back after that, and that's where we had an opportunity to start following Occidental and looking for a trade on it. So the failure of this short-term trend to sustain itself doesn't necessarily mean that this one won't. It does mean the long-term downward trend is very strong, and we've got we've got that going all the way back here to late 2022. So looking good. We'll see if it continues. But with that in mind, let's take a look at next week's contracts. I need to expand this just a little bit. There we go. And again, for reference on the trade, I brought in $1.06. So 41. I could buy this one back for 15 cents right now. There's still 7 days to expiration. So still got some time value left in the trade. That means that if I put in a buy to close order for this one right now, I would close out the obligation. I sold one contract on this, so this is very conservative position size at $4,100. But I would close that out 7 days early. I would still hang on to probably about a little over 85% of my premium, which is nice. Most of the people who like to work with rolling strategies will actively consider opportunities to roll a trade once they can keep at least 50% of the premium they brought in. Why are they so active? Well, it's really, as we've talked about in previous sessions, all about trading frequency. If you can turn a planned 3-week trade into a 2-week trade and turn around, whether it's with the same stock or something else, redeploy the capital right away. If I bought this back right now, my capital would become immediately available to be redeployed as long as the market is still open. So I could immediately turn around and look for the next trade. So for example, here's 43. This is the at the money strike price right now. Could bring in 59 cents for the next 7 days. You're not rolling any further out in time, but you are rolling a little bit up in price. And you're still able to get a little over 1%, excuse me. This would be 1.37% for 7 days. That's interesting. Here's 84 cents, not quite 2% for 2 weeks. So the activity in these contracts is obviously quite a bit higher. Implied volatility is quite a bit higher. 200 contracts here for 2 weeks out. Yeah, these are weekly options, and you've got plenty of activity going on in these right now. So this is very interesting. Again, not a recommendation to buy or sell, but if any of you are also here in Occidental, be interested to see what you're doing or what your attitude and opinion about this is. So I'm going to let this sit for the next week. I'm in a good position, and it sounds a little bit passive, I know, but my method is to set the trade, let it run to expiration, and then the result is the result. If I get assigned, I get assigned. That's fine. I like these stocks at the strike prices that I'm selling. So for me, $41 is a nice purchase price. And my trade is a good enough result. So if it expires worthless next week, I'll have an opportunity to set a new trade with Occidental the week after. I may or may not use it at that point, but there'll be that opportunity. Okay. The next one is Bristol Myers. This is a stock I've used quite a bit over the last couple of years. The last one I closed the last position in the first week of December, And then here at the beginning of January, was able to sell the $55 strike price for about 1.5% for a 3-week trade. So let's go over here to look to their chart and see what's going on. Stock has rallied very strongly. And so we've got it up here. It's really been consolidating up here at the top of this range. And this is, I talk about the chances of a stock retracing a trend that is this aggressive, but sometimes a retracement is very, very minimal. All it really means is that the stock should lose a little bit of momentum, a little bit of its bullish momentum. And so sometimes that translates into a consolidation range, which can happen at the top or bottom of cycles within a stock's price. And it just creates a sideways motion that the longer it lasts, the more it flattens whatever whatever the next longer trend may be. We see that with the 20-day moving average, which had been going up and now is starting to, it's not exactly flattening, but the slope is starting to change. It's becoming a little bit more gradual. These are all these in the long run for Bristol Myers. These are usually bullish indicators that the longer term trend is set to reverse in a bullish fashion. And for now, it just simply sets up a good opportunity to manage my trade. Here I am at 55, and I'm still a couple of weeks to expiration on this one, but the stock is pushing up a little. It's dropping back today, but it's at about 56, and it's got top end resistance right now in this consolidation range at about 57. Support looks like right around 55. So very narrow range. Is it going to break above it? Oops. Or below it? That starts to become the question. Still could do either one. The odds are starting to shift a little bit more back in the bullish direction, however. This will be a catalyst for, I expect. I'm not trying to say that I know for sure, but this earnings report that is coming up in the first week of February is likely to be a catalyst either for a continued upward move, a confirmation of this trend since November, or if the market doesn't like it, it may break back down. We'll see. This trade expires next week, so the expiry is coming before this earnings report comes up. That also means that even if this expires worthless, I don't necessarily avoid placing a trade across an earnings statement if I feel the opportunity is good enough and the fundamentals, value proposition, etc., are attractive enough, and Bristol Myers is. But I try to be pretty careful about when I place those trades, and this would be a little bit too close to that earnings date to want to do that. So I would probably wait, assuming that this stock does continue to hold its price above 55 and my current trade expires worthless next week. I would probably wait until after this earnings report comes before I start looking for my next trade. But again, let's take a look at the current activity here. Now we're right at 56. And I brought in, again, for reference here, this was 83. Yep. I brought in 83 cents on this one. And remember, I said the rule for most rollers is to consider buying back if you can hang on to more than 50% of your premium. Buy a close order on this one right now would cost about 28 cents, which isn't bad. The last trade was 25, so you could probably set a buy to close order for even less than the 28. You don't have to take what the market is listing. You can set a buy to close limit order for whatever you want. There's a fair chance that you would get that if you went somewhere between 20 and 28 right now, 25, 24, something like that. Fair chance you would get that and hang on to most of the premium that you kept. Then you can decide if you want to continue to here's another 3-week trade at 55, bring in another 84 cents. These aren't terrible. Here's how this would work in terms of the compounding effect. So 55, here's the 0.83 that I already brought in. If I let this expire, which again is my normal method, that's 1.5% for a 3-week trade. Now that's attractive. I like that. But here's where accelerating your trading frequency becomes useful. Keep that 1.5% in mind. Okay. If I bought this back, I'd have to, if I just took the current listed asking price, I'd have to pay 28 cents. So I'd hang on to 55. So I'd have exactly a 1% result in this trade with still 7 weeks to go to expiration. 14 days doesn't look that attractive, but if I go out to February week 1, and I take this 84, let's take a look at the details here for a moment. There's no volume, which is in part an accounting for the difference here between bid and ask. There's enough open interest though. Previous close is 92. If I took that 84 cents, I just decided that was okay. So it'd be another 3-week trade. Now the total premium that I would have brought in this case is $1.39. When I divide that by 55, now I have 2.52%, and I've extended my trade out to February week 1. I started this in January week 1. So now, instead of 1.5% for 3 weeks, I have an opportunity here to expand my result to a little over 2.5% for 3 weeks, or excuse me, for 4 weeks. I apologize, for a 1 month period of time. This is the advantage that rollers give themselves, that more active traders are able to give themselves. It's a 1% difference. By extending out for about one week further. This doesn't always happen like this, but if you think about that every single week, okay? If you can repeat this same result every week versus the more passive guy like me, I'm going to do 1.5% every 3 weeks. Again, not a terrible result, right? I'm going to be in the 20-something percentile, but this has got me beat by 50% over the course of a full year. And Gib, you're absolutely right. You got the earnings on the 5th that you got to think about. And that's why I said, You've got to decide if you're willing to deal with that. That's part of the reason that this looks that attractive. Periods ahead of earnings announcements do see an increase in not only volatility in the stock, but implied volatility in the options as well. So you're going to see these premiums become a little bit elevated. Doesn't mean they're not worth doing. It just means that you need to consider it. So totally agree with you. Not a recommendation to buy or sell, just stating the facts as they are on the ground in the moment. Giving you the possible choices to work with. There's lots of different ways that you can use put selling to really achieve some impressive results. And again, if you're not afraid of the earnings announcement, if Bristol Myers is a stock that you would own anyway, maybe that becomes worthwhile. If you're looking for opportunities to maximize your price or minimize, in effect, the price so that you can maximize your result, then maybe you wait until after the earnings report. There's not really a right or wrong answer here. All right. The last put sale that I have on deck also is set for expiry on the 30th. So still a couple of weeks to expiration, but that was this week's put sale on Nike. I sold the $64 strike exactly 2 days into the trade, but I brought in $1.18 on this one, a little under 2% for 2 weeks. So let's just check in on Nike, see where we're sitting at the moment. So it's right very near my strike price. It's been retracing back for the last few days. When I posted the trading alert, it was right up here at the 200-day moving average, sitting on resistance, and now it's pulling back again. So really the next question on this one for Nike is, where is support going to be? I expect that it is likely to be somewhere around this pivot low, which is right in line right now with the 20-day moving average, which is at around 63. So pretty close by. We do also have the 20-day moving average bending back down because of the momentum of the last few days, where it had been flattening when I was looking at the trade, when I send out the trading alert. So this one will be, as always, be interesting to watch. And I certainly don't expect there to be any opportunity here to try to roll this one. However, for those who are more active timers, this pullback, I'm going to change my color here. This pullback could be an indication that near-term momentum is clearly more bearish. Not only am I stating the obvious, I'm trying to point out that there could be some additional downside on these. Thank you, JW Talks Life. I appreciate. I really appreciate that comment that these are useful. So thank you so much. I really appreciate that. Please share the links to these live streams with people that you know that you think may also benefit. Let's try to grow the community and have lots of people participate. Not only am I stating the obvious in terms of what the momentum is right now, I'm also trying to make sure to make it clear that there is a chance here that downside risk could be increasing. I expect support to be down here around 63, but I'm also aware that I could be wrong. If I am wrong, and it's possibly down here a little bit below 61, for the sake of argument, I'm just going to call it 60. possibly even 57, based on these pivot lows. And that's just going off of where the stock has found opportunities to swing back to the upside lately. Momentum on Nike has been bearish for a very, very long time. That's why we have a clear downward trend on the 200-day moving average. So these attempts that we've seen to reverse the upward trend, I thought at the time in the middle of last year that this was starting to look like a pretty good trend reversal. Well, obviously that failed. Sometimes the longer trend will just simply reassert itself. Now, again, as a put seller and a value hunter, bargain hunter, these don't bother me. These set up opportunities for new contrarian-based trades. But you're a fool if you're not also thinking about and recognizing the potential for some of this downside. And this is why this caveat that I always publish with my trading alerts, that by selling the $64 strike price, I am actively saying that I'm willing to buy the stock at $64. Well, if I get assigned in 2 weeks at $64 and the stock is down here at 60, that's a world of difference than if the stock is held up at 63. If for whatever reason it's possibly picked up even more bearish momentum and it's down here around 57, again, the conversation feels a little bit different than if it's at 60 or 63. You have to be willing to acknowledge those possibilities and to decide if you're willing to deal with them. This is one of the things that contrarian investors, and I put myself in the category of a contrarian, this is one of the things we try to make sure that we are thinking about and accounting for, but they don't necessarily scare us. Even if it's down at 57 and I've got it at 64, okay, yeah, I'll be a little bit underwater on the position. And given the strength of the downward trend, it could stay that way for a little while. Again, we're going all the way back to actually late 2021 was the top of the range for Nike. So again, calling a spade, there is a reason that Nike is as depressed as it is. So ultimately, again, we're going to have to see what happens. For now, am expecting pretty solid support around 63. If this does hold, then what we'll see is a continuation of, there's my 63 support. 200-day moving average, interestingly, right now is flattening out. So for all the bearish talk I've just given, this flattening of the 200-day moving average is a net positive for me as a put seller, because it suggests that if we see a bounce anywhere between the stock's current price and 63, what we will probably start to see is a consolidation range begin to form. The 20-day moving average will also start to flatten out. I expect this top end, which is right around 66.50, should become new resistance. And if this becomes a legitimate consolidation range, may extend for a month or so, that will actually be kind of fun. I like consolidation ranges. As an income generator, consolidation periods are actually really, really productive. You're usually able to place multiple trades, whether they're put sales, if you end up owning the stock, covered calls, whatever, you're usually able to do multiples of those income generating trades in any given consolidation range. I've had some consolidation ranges that extend over months, and I'm able to place 4 or 5 different trades with the same stock. Those are fun. So we'll see what happens. I'm calling out the potential for a consolidation range. At the same time, I'm acknowledging the possible continued downside. So any of these is a possibility. We're just going to have to wait and see how it actually shakes out. So, all right. Jay could not find the stream. Sorry about that. I did send out the alert early yesterday. Jay, I do know you're also on Discord, so if you still have that app, remember I also always post it here. Well, I apologize. I forgot to post it here. You're right, Jay. Did not see it on Discord because I did not post it. That was my failure. So I apologize. I put it up on Substack. I even put it up on Patreon. I did not do Discord. I usually put it up on all three, but I missed this one. So my apologies. I will do better. All right. That is all of the trades that I've been following. Yeah, thank you, Jay. A little bit of grace is nice, right? These are all of the trades that I've been following lately, and we've obviously got some time left in the session. So if there are some stocks that some of you are interested in, certainly would be happy to take a look at those. Just understand that there's a good chance that I'm not following these stocks, not necessarily because they're bad, just means that they're probably not in my watch list. But sometimes these offer some opportunities to consider some new things. That's where Occidental came from. So if there's something you're following that you would like to share with the group, this is where we have some time. Thank you, Barry. All right, he's been holding RILY for a while. Sold a $7.50 call earlier this week, and then The drum roll, please. BRC Group Holdings. All right. Sold a 750 call. Tell me what you brought in on that. And said that you've been holding it for a while. So it looks like you're probably in a pretty good position right now. Cost basis is down under 4. Okay. I can't speak to this company at all. I'm not familiar with this company. Investment bank brokers is the industry that they're in. They do not pay a dividend, so this is a stock that even if it had crossed my desk, it would not end up in one of my watch lists. And again, this does not mean it's a bad company. It just means that it doesn't meet all of the criteria that I'm looking for the trades that I'm placing. I want dividend paying stocks so that when I do take assignments, I have those dividends as a passive income source. But talk about a big move, right? This is called parabolic, this move. Big gap yesterday and a pretty natural, especially for a stock at this price, pretty natural drawback the last couple of days is you've definitely got some profit taking. Okay. Paid a dividend when you started with it. Okay. Fair enough. And yeah, you're absolutely right. Here it is. Back in 2024. Wow. $1, 50 cents, 50 cents. Yeah. Oh my. Look at that longer trend. Stock was all the way up here, 21, 2022. That begs all kinds of questions. Brought in 44 cents last Friday, actually, for 5 contracts. Okay, so your cost basis is under $4. You brought in 44 cents. You just did 10% in 1 week. You got into it around 10, and then you've been working it. Okay. Well, with your cost basis then, so here's your initial purchase, right? But with the stock down here at 863, I guess the question for that covered call that you sold is when it expires. But with the stock up here at 863 and your call at 750, the question becomes, how do you feel about getting called out? Under normal circumstances, that's not a bad thing. This sounds like a little bit of an abnormal kind of a position. All right, glad to get rid of it. Fair enough. And this is giving you a nice runway to do that, then there is nothing wrong with that. So, Barry, you got a check mark earlier because you did better than me on one of the put sales, and here's one for BRC Group Holdings. So, one contract called out overnight. Yeah, no kidding, right? All of a sudden the stock's up here at 10 and you're at 750. I'm not surprised that somebody called you out on that one. But still, that's a good trade. And we don't have all of the details of all the trades that you've placed with that. But one of the things that put selling covered calls can be useful for when you're looking at stocks in downward trends is not just securing a price that you're comfortable with, but if the downward trend continues, being selective, you've been trading it since November 2024. Okay. So it's down in this range. Being selective about how you place some of these trades. And you'll see me, there are some stocks that I still hold at much higher prices. Pfizer, for example, where I will periodically put in a put sell at a much lower price because taking an assignment gives me an opportunity to lower my cost basis a little bit. I don't do those frequently, but from time to time, as I feel like there's a reasonable opportunity and it makes sense. Covered calls you have to be a little bit careful about because if you're selling a covered call with a strike price below the price that represents your cost, and all of a sudden the stock shows a lot of positive momentum, you can get called out without necessarily wanting to. So you have to pay attention if you're going to sell covered calls in a downward trend. But those premiums also can be counted against the cost basis as well. I've seen a number of people who've been part of Rebel Income over the years use both put sales and covered calls in combination on some of these kinds of positions to pretty reasonable effect. And then when you get something like this, finally you start to get the market starting to put a little bit of bullish pressure back on the stock again. It starts to accelerate. If you've been able to manage your cost down to $4 like Barry did, and now all of a sudden the stock is at 750 or is a little bit above $8, and you've got a chance to get called out at 750, yeah, then you said glad to get rid of it. That sounded like a little bit of relief there, right? Then that can be okay. I'm done with it. Thank you. It worked while I was doing it, and now I'm ready for something else. There's nothing wrong with that. So Started with one contract, started working at lowering the cost basis. Perfect. And that, going back to position sizing, one of the things that and this will be the last note, we're at time, but I'm gonna wrap up with this. One of the things to consider when you're thinking about position sizing, um, is not only how much is the total exposure you're willing to give yourself on any one trade. Like I said, right now my limit is about 2 to 3% of my account size. But depending on what the stock's price is, if you have the ability within the upward limit of what you're willing to accept for your position size, if that gives you the opportunity to sell more than one or two contracts, one of the things you can do, and this can make a lot of sense since we're really focusing on stocks and downward trends, you may think about only starting with one contract or a third, depending again, size, the account size you're working with and the position size you're planning here makes all the difference. But let's say that I were in a position to sell 6 contracts at once. Maybe I sell 2 contracts at first. So I'm actually cutting my position size by 2/3. Now, instead of maybe 3%, maybe I'm at 1%. And since the stock is in a downward trend, if that downward trend continues to extend itself, then I've only got 200 shares out of the possible 600 I was willing to take at the current higher price. And if the downward trend extends itself far enough, again, maybe there's an opportunity to go in with another 2 contracts, another 200 shares. And if I get assigned there, then the average of those 2 represents my new cost. This is what a lot of traders also call legging in to a trade, or setting up tiers for their positions. And it's a really, really smart approach to not only position sizing, but also setting themselves up for something like what we've seen with RILY in the future. So Barry, what you're talking about started with one contract and start working at lowering the cost basis. I'm going to give you another check mark, because what that represented for you was really smart strategy and really smart trade management. So that's really useful. I really appreciate you bringing that up as an example. So, okay. Well, we are at time, as I mentioned. So, as always, I really want to thank all of you for being part of the live stream today. I really appreciate your comments and your participation. I hope you have a great weekend. As always, if there are any questions, please don't hesitate to let me know. You can email me at rebelincomesystem@gmail.com, or reach out through Discord or Substack. Either way, you can direct message me in either one of those platforms. Again, thanks again. Hope you have a great weekend, and we'll talk next week. See ya.